hello everyone. Welcome to today's webinar. As I mentioned earlier, and for those of you who just joined, my name is Deborah and I'm the Head of Customer Success here at TFX. We are very excited to have you join us today as we dive into some common questions, review some key tax deadlines, and share how TFX can make tax filing easy and stress-free for you. So whether you are a US expat based in the US, our team of experts is here to help you navigate that tax season with confidence. We are here to assist all US taxpayers, both abroad and within the US. So let me quickly introduce TFX for those of you who may be new to us. TFX is a top-rated tax service trusted by over 50,000 clients worldwide. Our team consists of 80+ experienced CPAs and EAs, many with over 20 years of expertise in handling both US and expat tax returns. We specialize in optimizing your tax filings, ensuring that you get maximum credits and deductions possible while making the entire process smooth and stress-free. Today, we have a special session lined up. Our expert CPA, exceptionally qualified specialist, Rebecca O'Malley, will be answering some of the most common questions we receive from expats. Rebecca has many years of experience working with expats, so she knows for sure how to deal with taxes and ensure you receive the maximum tax benefits possible. After that, she'll take your live questions, so please feel free to start dropping them in the chat now. Also, as I mentioned, our incredibly skilled and highly experienced CPAs Reid and David are in the chat throughout the session, and they will be assisting you in real time. That's not all though. Please stay tuned, stay with us, because we'll also be giving away exclusive promo codes at the end to help you save on tax preparation with TFX. Okay, so I know that your taxes can be quite complex and we receive a lot of great questions from clients every year. So to make things easier, Rebecca will now walk us through some of the most common questions we get, along with clear expert answers to help you navigate your tax situation with confidence. So Rebecca, over to you.
Thanks, Deborah. Today's agenda will focus on discussion of the filing similarities and differences for US residents and expats. We'll define who a US resident is as well as an expat. We'll also cover the basics of how to avoid double taxation. And two of the most common ways to do so are claiming the foreign tax credit or the foreign earned income exclusion. We'll talk through strategies for making contributions to IRAs while living abroad. And specifically, we'll go into details on the backdoor Roth conversions, which make the Roth IRAs accessible to those who are over the maximum contribution limits. We will talk through totalization agreements, which cover Social Security and Medicare for employees and self-employed. We'll talk about why they're important to understand and the implications of living in a country that either does or does not have one of these agreements with the United States. We will wrap up the presentation portion of today's webinar by going through the deadlines for filing 2024 taxes in 2025. And then we will talk about how we at Taxes for Expats could help make the process easier for you and assist you in some of your tax planning. So the first area we'll focus on, as I mentioned, is the filing similarities and differences for US residents and expats. So both US residents and citizens living abroad are subject to reporting their worldwide income to the IRS on their resident tax return. But there are key differences between those filing requirements on whether you are a resident in the United States or an expat outside of the United States. So we'll talk through some of those key differences, what exclusions and additional forms may be required. But first, let's define who is a US resident and who is an expat. So when we refer to in this presentation US resident, we're referring to US citizens, green card holders, and those who meet the substantial presence test. When we report or talk about expats, we'll be referring to US citizens and green card holders who live outside the United States. So again, both of these groups of individuals are required to report their worldwide income to the United States. But if you're an expat, you may qualify for some exclusions and credits, which can reduce or eliminate your US income tax. So what are the differences between filing US taxes in the US abroad? So as I mentioned, there's many similarities. So you're still going to report your wage income, your interest income, dividend income, self-employment. rental income. Those are all going to go on the same schedules that they normally would if you're living inside the United States. But there's key considerations for each of these items if you are an expat. For example, wages. In the United States, if you have a U.S. employer, you contribute to a 401k and your employer does a match. You don't have to report any of the employer contributions as income. But if you live in certain countries, depending on the tax treaty between the US and that particular country, you may have to report the employer contribution to your non-US retirement account as wages. So that can come as a surprise to some people. For interest income, again, it's reported on your tax return, whether you're in or outside of the United States. Some countries, for example, the UK, they have an ISA account, which is not taxable in the UK. But it is actually taxable in the US. So that's another area where some people are unsure of how it's reported. For dividends, if you have US dividends, oftentimes they're qualified dividends and you're subject to a reduced rate of tax. And depending what country you live in outside of the United States, there are tax treaties that can reduce those tax rates. So we look at the taxes, and those tax treaties could actually make some non-US dividends become qualified and eligible for the discounted capital gains and qualified dividend tax rate. We have many of our clients are self-employed or they operate businesses outside of the United States. And while there's many similarities for a self-employed individual taking similar deductions as if you live in the United States, there are some differences. So one of the benefits for self-employed in the United States is something called the qualified business income deduction. If you live outside the United States, that deduction does not apply, but there are other benefits where you could exempt your self-employment income from being taxable or subject to the self-employment tax. Rental income, again, very similar to how you would report it if the rental property were in the United States, but there are different depreciation lives for assets outside of the United States. For self-employed or for self-employed or rental income, there are additional information returns that the IRS requires to be filed as well. So when we are working with you, we would assess your whole situation, determine the filing requirements for each of your types of income, and then, as we'll talk about in later slides, determine how we can avoid double taxation and reduce your taxes for the United States. So you may also be subject to tax in your local country on the same income that is taxed by the United States. And as I said, there's several ways that you can avoid double taxation. And in some cases, if you're in a country with no income tax, your US income tax can also be low or zero. So we talked about several of the differences between filing taxes for residents versus expats. And now we'll review some of those benefits that are available to you as an expat, whether you're a US citizen, a green card holder, living outside the United States. And so one of the most common benefits is the foreign earned income exclusion. This is for US citizens or residents living abroad. And you can actually exclude up to, in 2024, it's $126,500 of your earned income from being taxable in the United States. So this is any income you earn from self-employment or wage income. If you meet certain requirements, which we'll cover, you would still have to report the income on your tax return, but it would not be taxable up to that threshold. And US citizens in the United States and outside of the United States, US residents and expats can claim the foreign tax credit. So this is taking a credit on your US tax return for taxes that you paid to another country on income that is taxed by both countries. And this is how you would avoid that double taxation. The US also has tax treaties with close to or over 100 countries. Under these treaties, residents, not necessarily citizens, but residents of foreign countries are taxed at reduced rates or exempt from US tax on certain types of income. And each treaty varies from country to country. It is important to note, because this is a question that we often get, many individuals will read the tax treaty and there's many articles in there with significant benefits. But we do have to remember and point out that each treaty does have what's called a savings clause. So while there are many treaty benefits, which may be applicable to certain individuals, if you're a US citizen or a resident, this saving clause kind of takes away the benefit of many of those treaty articles. But we do work with our clients. There are several of the articles that are still applicable. So there's articles regarding Social Security, pension contributions, foreign tax credits, and resourcing of income. And so these treaty articles still do provide significant benefits to expats. And so we will talk about some of these areas in the later slides. General filing obligations also include reporting information about your non-US accounts and assets. And so the FBAR, and you may have heard of the FBAR or the FATCA, the FBAR is filed with the US Treasury. This is filed annually, and you don't owe any taxes. It's just reporting information about your accounts. So you would report your ownership of accounts, or if you have signature authority of financial accounts. When you look at the aggregate of all of your accounts outside of the United States, if that aggregate balance exceeds $10,000 in a year, then you would have to file the FBAR. And this is per individual. So if you and your spouse each have accounts, you would look to see if you each have a filing requirement. And then the FATCA, this is very similar to the FBAR. It reports much of the same information, but this is filed with your tax return. And it also includes other financial assets that are not necessarily held in accounts. So for example, if you own stock in a company directly, that would be reported on this form, but not the FBAR. In this FATCA also, you do not have to report accounts where you have signature authority only. So again, as I pointed out, the FBAR is for accounts that you have that when they exceed $10,000. So these include bank accounts, retirement accounts, investment accounts, some accounts that people don't necessarily think of are life insurance accounts that you have that have a cash surrender value, annuity accounts. If you own a business, it includes your business accounts and trust accounts. The FATCA filing, again, this is the one that is filed with your tax return. This has different thresholds than the FBAR. The thresholds also depend on whether you live in the United States or outside of the United States. So the threshold for your assets is lower if you're living inside the United States. So again, this is the same accounts as the FBAR, but does not include the ones with signature authority only. So if you're living in the United States and your non-US financial assets exceed $50,000 on December 31st, or $75,000 at any time during the year if you're filing single, you'd be required to include this form with your tax return. Those thresholds double if you're filing jointly. If you live outside the United States, as I mentioned, are a bit higher. So if you exceed $200,000 in your non-US financial assets as of December 31st, or $300,000 at any time during the year, this form would be required to file with your tax return. And there can be penalties for failure to file for these reports, the FBAR, as well as the form, the FATCA form 8938. So as part of our process, we do inquiry with you to understand all the financial accounts that you have and make sure that you're properly reporting them on these forms. So if you're someone on the call today who has never filed a U.S. tax return, or you haven't filed for several years, perhaps you didn't know that you had a filing obligation now that you have moved outside of the United States, you may be eligible for one of the relief procedures that the IRS offers. So one of the more common ones is the streamlined foreign offshore procedure. This one is designed for taxpayers who live outside of the United States and who have not filed a U.S. tax return or FBAR and need to catch up. Also, your failure to file has to be non-willful. So you do have to present to the IRS the scenario of why you hadn't filed. And so you know, if you just purposely did not file to avoid paying income tax, you would probably not be accepted through this program. But for most of the people we work with, you know, they just were unaware of the filing requirements. And so this is a great way to catch up. So the IRS requires that you would file 3 years of tax returns and 6 years of FBARs through this program. And then if you file through this program, you would not be subject to paying any failure to file or failure to pay penalties. However, you would be required to still pay any income tax that was due and any interest that would have been due for those taxes. So you can use this QR code if you'd like more information on the streamlined procedure. It will bring you to our website. We work with hundreds of clients every year getting back into compliance. There is another procedure. We have many clients who are giving up their citizenship. And as doing so, you are required to certify with the IRS that you've been compliant with your tax filing obligations for the year of renouncing as well as the 5 previous years. So the IRS does have a program specifically for this group of individuals, and it's called Relief Procedures for Former Citizens. So for this procedure, you would have your tax returns prepared for the 5 years prior to renouncing, as well as that final year. And as long as you have never filed a tax return before, as long as your total tax due for those years is under $25,000, and again, your failure to file was not willful, then and your net worth is under $2 million, then you would qualify for this program. And the difference between this program and the streamlined is that through this program, the IRS doesn't actually make you pay the income taxes due as long as they're under $25,000. So this can be a great program for individuals who are looking to renounce their citizenship, and at the time they realize they had filing obligations that they weren't aware of. So if you'd like guidance on whether you're eligible for either of these programs or how to use these programs, we can definitely set up a call with you afterwards. You can ask anything in the Q&A, and we can assess whether these would work for you. So again, back to how do we avoid double taxation, or how do we reduce our income tax in the United States while we live abroad or have income from abroad? So we talked about in general benefits of foreign tax credit and the foreign earned income exclusion, but we'll go into a little more detail on how each of these are applied. So one question we frequently get is, okay, so the foreign earned income exclusion, that's for earned income. We said that was to exclude income from wages or self-employment. But what about your other income? What about your investment income, income from PFIX, income from rental properties? How can we, if we're claiming the foreign earned income exclusion, how can we also avoid the double tax on that income as well? So we often get asked if we can use the foreign tax credit and the foreign earned income exclusion together. And so that answer is yes, you can use them together as long as you are aware of certain calculations that have to be done to ensure that you're using only the proper amount of the foreign taxes paid. So what is PFIC income tax, or what is investment income tax? This is tax on passive income that you have versus taxes on earned income. So let's review some basics. So for the foreign tax credit, this is, again, it's a tax credit that the U.S. would give to offset your U.S. income tax for taxes that you paid to another country. So your tax return would be prepared reporting all of your income. You would calculate the U.S. tax that you would owe. And then there's a separate calculation that's done. There's a picture of the form here, the form 1116. So you would calculate the foreign tax credit, and then this credit would offset your U.S. income. So to qualify for the foreign tax credit, the taxes that you pay actually have to be an income tax that you paid to another country and a legal liability that you owed. So it can't be personal property taxes. It can't be real estate taxes. In some cases, it can be a wealth tax. There's a few countries that charge a wealth tax, and some of the wealth tax is based on assumed income from some of your assets. So in those particular cases, we would work with you to get that information and make sure we're taking advantage of all the credits you could apply for. So the income that would be calculated as eligible to take the foreign tax credit, so it must be foreign sourced. So there's different types of income, and the sourcing for different types of income varies. So for example, compensation for services is sourced where you actually perform the work, not where the payer is located. Sourcing of dividends is based on the country in which the payer is a resident. And days, this is another area where some people don't realize that if you live outside the United States, let's say you live in the UK and you're traveling to the United States for a conference or for work for a few weeks, the income associated with those days in the US is actually considered US sourced. And so in general, it would not be eligible for the foreign tax credit. But there are some special situations where many of the treaties do allow you to take that U.S. source income and they call it resourcing it as if it were UK, as long as you paid the taxes to the country with that benefit. So we would, again, work with you. We would understand all of the days that you're in the United States. You would look at which particular country you live in and see if we can apply that resourcing so that you can still claim that foreign tax credit on that income. that you worked in the United States. So calculating the foreign tax credit, it can be complex. There's many factors that go into allocating your income. For example, categories. So I touched upon this a little bit in that your wage income is in a different category as passive income. And so for the foreign tax credit, there's 7 different categories, but the 2 most common are the passive income category and general. So your wage income and other compensation, pension income, that would fall under general. But for income that is more investment income, dividends, interest, capital gains, rental property, that's considered passive. And so when we calculate your foreign tax credit, we do have to understand what income tax you paid to the foreign country, and split that between the 2 types of income. So for example, if you paid tax to a country, but they did not tax your investment income, then you really wouldn't have foreign taxes to claim as a credit against that investment income that was taxed by the US because you didn't get taxed by another country. So in general, if you pay taxes to another country, as long as you were taxed on that income by both countries, then you'd be eligible for a credit. So the foreign earned income exclusion, again, this is the exclusion that you can take for 2024. It's up to $126,500 per individual. So if you're 2 spouses married filing jointly and you both have earned income from self-employment or employment, you can each exclude up to $126,500. There is something called a foreign housing exclusion or a foreign housing deduction, which can increase the amount you can exclude. It's based on rental expenses that you pay for your housing in other countries. We won't get into that in too much detail here, but I wanted to point out that in some cases, that $126,500 can actually be a higher exclusion. So, okay, we talked about the exclusion and the tax credit, but who qualifies for the foreign earned income exclusion? We know that the foreign tax credit, you qualify if you pay taxes to another country. But for the foreign earned income exclusion, the requirements are a bit different. So there's 2 tests that you can see if you qualify. So the first one is the physical presence test. So to pass this test and be eligible for the foreign earned income exclusion, you do have to be outside of the United States for 330 full days in a 365-day period. So again, you would keep detailed records of your travel to the United States during the year, and that will allow us to determine if you are eligible based on this test. Or there might be other individuals who, they have a permanent home, their domicile is outside of the United States. So this is a little bit more subjective. This one is called the bona fide residence test. And so this looks at many factors, again, looking to see where your domicile is, where your tax home is, where you have more ties, where is your family living, where do you keep your financial accounts. So if all of that is outside of the United States and you have pretty limited ties to the United States, you could still travel back to the United States more under this test. You could travel back to the United States more frequently as long as your permanent home is outside the United States. So you could meet the requirement that way as well. And so you can claim the foreign earned income exclusion even if you live in a country where you don't pay any income tax, or it's a country where you have very low income tax, or if you're a digital nomad. So even if you do not, or you're not resident in the country outside the United States, the foreign earned income exclusion would still apply to you. And in those cases, it's actually a great benefit because you're either paying low or no income tax to another country, and up to the annual threshold, 126,500 in 2024, you can have excluded from tax in the United States. So there could be individuals that end up paying no income tax with these benefits. And for those individual taxpayers who live in a country with a higher tax rate than the United States, we would determine, is the foreign earned income exclusion, is it most optimal for you? We would look at other factors as well. Do you claim the child tax credit, or do you want to make retirement contributions? Do you have significant foreign tax credits that have carried over from prior years? The foreign earned income exclusion is not the most optimal for everyone. Again, in certain situations, claiming the foreign tax credit may be better. So we would work with you. You would understand, which benefits and credits you would qualify for and see what's most optimal. So for example, if you live in a high tax country, where the tax in that country is more than the US tax. You may benefit by claiming the foreign tax credit and taking those extra taxes that you paid to the foreign country and carrying them over as credit carry forwards to use in a future year. We have many individuals who have children and living outside the United States, they may qualify for a refundable child tax credit. So even if you don't pay any taxes to the United States, if you meet the qualifications with qualified children, you can actually receive a tax refund of $1,700 per child in 2024. If you claim the foreign income earned income exclusion, this benefit is not eligible for you. So especially for people with children, we would look and see, is it better to claim the foreign tax credit in that case? We do have many clients who make retirement contributions during the year to IRA accounts. So in order to do so, you do need to have taxable earned income. And so you would either, see if the foreign tax credit is a better fit, or with the foreign earned income exclusion, perhaps there is a way to ensure that you still have taxable income to make those contributions. So yeah, to summarize, we evaluate every client situation, and we select and we discuss with you the various methods and see what may optimize your return. In some cases, if you were someone that you just came over and started working with us, you've been claiming the foreign earned income exclusion for years, but we determine you have a child now, so now you could get this refundable credit. So we might advise you to revoke the foreign earned income exclusion, which can sound scary, but what it means is that you would basically, instead of using the foreign earned income exclusion, you would use the foreign tax credit and the child tax credits to offset your tax. And you can, if you revoke it, you can't use the foreign earned income exclusion for 5 years. After that 5-year period, you can use it again. So again, we advise you of this limitation, and make sure that for the next 5 years, this strategy would work best for you. So we often get asked, can I still contribute to an IRA when I live abroad? Can I still contribute to an IRA when I have a foreign employer and I only receive wages from outside the United States? Some people are in a situation where they are filing separately because their spouse is a non-resident alien. And they say, can I ever contribute to a Roth IRA since my income is over the limit of $10,000 for married filing separately? So we'll answer these questions for you. But the answer to all of these is yes. And so we'll talk through some of these situations. So yes, you can still contribute to IRAs when you live abroad with some careful tax planning. So you can contribute to an IRA if you're paid by a foreign employer, as long as you have what I referred to earlier as taxable earned income on your tax return. So even if the income is from outside the United States, again, you're still reporting worldwide income on your tax return. And as long as some of that income from employment is taxable and not fully excluded by the foreign earned income exclusion, then you can still contribute up to the maximum amounts each year for traditional IRA and Roth IRA. There are limits to determine whether the contributions to traditional are deductible, and for the Roth IRAs, there are income limits on who can actually make contributions. So the maximum IRA contributions you can make in 2024 and 2025 are $7,000 for those under 50 and $8,000 for those over the age of 50. And as I mentioned, your contributions are limited if your income is over certain thresholds. So for the Roth IRA, many people like the advantages that a Roth IRA offers. It's the tax-free growth and tax-free withdrawals and retirement. So it can make it a powerful tool for long-term savings. These contributions are made with after-tax dollars. So there's no tax deduction at the time you make the contribution, but you do get the benefits of the tax-free growth. In addition, there's no, unlike traditional IRAs, there's no required minimum distributions once you reach retirement age for the original account holder. And then this is something that many people are unaware of as well, is that those contributions that you make to the Roth IRA accounts, you actually can take those contributions out at any time, penalty free, if you need that money. So as long as you're not taking out, any amount over the total contributions you made, then you can take that money out if needed. So many, as I said before, many people, for some reason or another, maybe their income is too high Maybe they are filing separately, and so which has a very low limit on what your income can be to contribute to a Roth. So a popular strategy is something called the Backdoor Roth. So this allows people who are over that income limit to still contribute to a Roth. And it involves contributing first to a traditional IRA. And so your contribution to that IRA, it could be pre-tax, or you can designate it as an after-tax contribution. So if you designate a contribution to a traditional IRA as after-tax, you can then pretty easily move it over and convert it into a Roth IRA with no tax impact or little tax impact. If you do have other traditional IRAs that are open with balances, then we do have to consider there's something called a pro rata rule that applies, which could potentially cause you to be taxed on that conversion. So we would help determine for you, whether this strategy is a good fit, whether it's a good fit. It could be a good fit for those who exceed the Roth IRA contribution limit. If you have no or low balances in other traditional IRA accounts, it could be a good fit. And if you plan to keep the money in the Roth IRA account long term, it can be a good fit for you as well. When you do a conversion, just be aware that you can't take those contributions out until 5 years after. So I had mentioned before that you can take contributions to Roth IRAs out at any time. When you do a conversion, there is a slight limit where you have to leave it in there for 5 years before you can take it out. But overall, yeah, the benefit is the tax-free growth and tax-free withdrawals at retirement. So for some people, this may not be a good fit if you have large balances in your traditional IRA accounts. But there is a workaround that we could explain. If you have 401k accounts, you can kind of take those IRA dollars and move them into a 401k before you do a conversion. That would allow your converted amount to be all after-tax dollars. So some of these strategies, they can sound a little bit complex, but we would talk through them with you, in more plain English, step by step, how to go through the process. So this can be a big benefit for whether you're a U.S. taxpayer in the United States or outside of the United States. So if you're an owner of a business, there are certain business filings and obligations, whether you're in the U.S. or outside of the United States. So these are mostly informational returns for if you have a foreign business. And in some cases, you may have to report some of that income on your U.S. tax return. So we would work with our clients to understand their filing requirements, advise on the most tax efficient way to structure your business, and prepare the returns to comply with the filing requirements. So in this presentation, we're going to just focus on the tax implications for self-employed individuals living outside of the United States. That's one of the more common types of situations that we see. However, we do prepare returns for all types of entities, partnerships, S corporations, C corporations. We do prepare the return for ownership of foreign corporations and trusts as well. So what are the tax implications for a self-employed individual living outside of the United States? So as I mentioned a bit earlier, there's something called a QBI deduction, a qualified business income deduction. For self-employed individuals in the United States, this is a 20% deduction that you can take of your net self-employment income. This is actually set to expire as of the end of 2025. If not extended. But this is a benefit, again, only for those in the United States. So you're not eligible for it if you live outside of the United States. But in turn, you could instead claim the foreign earned income exclusion or the benefits of a Social Security Medicare treaty between the US and another country. If you are self-employed outside of the United States, again, you're reporting your income on Schedule C just as you would if you were working in the United States. But there is another informational return that is required to be filed. That's called Form 8858. So we would prepare this form for you as well. And one of the main differences of, self-employed, someone working in the United States versus outside of the United States is the self-employment tax. And so if you're self-employed in the United States, you are probably aware that you have to pay a self-employment tax, which is 15.3% of your net earnings from self-employment. So, this is paid, you can pay it as estimated payments or with your tax return. But if you live outside of the United States and if you live in a country which the United States has a totalization agreement with, then you would, if you're self-employed, most likely you would just pay the self-employment or similar type of Social Security tax to your local country. and we would claim an exemption on your US tax return. Again, this is avoiding double taxation with regards to Social Security and Medicare. So these are referred, as I said, totalization agreements. So there's tax treaties that the United States has that covers, how your income is taxed and relief of double taxation of income tax. But these particular agreements, there are less countries that have totalization agreements than tax treaties in general. But the purpose of these is to eliminate dual contributions having to be made to the United States and to another country. So this also is it covers how retirement benefits will be paid upon retirement as well, depending on what country you live in, what country you contributed to. And it ensures that employees and self-employed don't contribute to both countries. And if you reach the retirement age and you realize, maybe you worked outside of the United States for most of your career and you don't have enough credits in the United States to claim the US Social Security, depending on what country you live in and the terms of that totalization agreement, you may be able to transfer some of your credits from the other country to the United States and then be eligible for US Social Security benefits. And in some cases, you can actually qualify for benefits from both countries. So we're familiar with these agreements and we can talk through any questions that you have and help ensure that you're, again, not paying double taxation on the Social Security and Medicare. So like tax treaties, you mentioned that every tax treaty was unique and has its own nuances. So it's very similar for the totalization agreements. Each one is unique. The benefits and coverage vary whether you're an employee or whether you're self-employed, and factors whether you're a citizen of one or both countries, whether you've been in the country for a certain number of years or plan to be there for a certain number of years. All these factors come into play with determining and interpreting the terms of the agreement. So you can check with us. You can check with the IRS or Social Security Administration and see if your host country has a totalization agreement with the United States. So as we are now in March, we are coming up on many of the tax deadlines for this upcoming filing season. So March 17th, which is a Monday, normally the deadline is March 15th, but it falls on a weekend. So for March 17th, there are some business tax deadlines. So these are for S corporations and partnerships. April 15th is a deadline for making your first estimated tax payments for 2025 for corporations as well as individuals. And April 15th, as most of us might be aware, is the tax deadline for US-based taxpayers for Forms 1120 and 1040. So if you are an expat living outside of the United States on April 15th, you actually get an automatic extension. You don't need to do anything to qualify for this extension other than living outside the United States. And then when we file your tax return, we include a statement that says you qualified for this extra bit of 2 months to file your tax return. So the IRS gives you a little bit extra time, as it can be difficult sometimes in gathering your documents from outside the United States. So April 16th is the deadline for 1040s for individuals living outside of the United States. And so for a full list of other important dates, you can use this QR code and check out our deadline page. So if you can't meet some of those deadlines that we just talked about, you can file an extension. We can file this extension for you. So wouldn't it be great to push your deadline out a little bit? So you can push your deadline out to October 15th for your personal tax returns, September 15th for business tax returns. And the good news is that we can help you with that. So there's no downside to filing an extension, only upside. I do want to point out with an extension, you want to make sure that, that you're just understanding that the taxes that are due, those still are due by the original deadline, but actual filing the return, we can extend that for you. And you can request an extension in your Taxes for Expats portal. It literally takes 1 minute and then we would file the extension for you.
Thank you, Rebecca. That was a lot of information, really valuable. Thank you very much. I'm sure everybody will agree they got a lot out of that. The questions in the Q&A section have been flying through thick and fast. I see some of you have put some questions in the webinar chat. Please make sure to hit the Q&A button at the bottom of your screen, and you can have some of your questions answered. So if you haven't asked a question yet, please feel free to put it in the chat. Reid and David have been super busy answering questions. Rebecca, I just want to say, the nuances of American taxes are for expats specifically are truly overwhelming. And I'm really glad that we don't have to do this alone, that we don't have to navigate this on our own. We've got you and other CPAs who are really great and qualified and able to assist with these navigating these taxes for us. I can't imagine doing this myself. So that's really, really great. So we're going to move on to our Q&A session with Rebecca, who is our expert CPA. She'll be answering some of your questions that you've put into the Q&A section. She'll be answering those live. So if you haven't submitted your question yet, please feel free to do that now.
We have some questions. I'll just kind of go through them and answer, scroll through them and answer them. So we have a question from Lee. It says, hi, I currently live and work in the UK for a UK employer. Should I report my pension as part of my income on my tax return or on my FBAR? It's a private pension through the employer who matches my contribution. So the UK and the US have one of the most favorable tax treaties, and one of the treaty articles that you can still take advantage of if you're a US citizen is the article regarding pensions. And so your employer contributions to your pension account, you do not have to report those as income. You also get to deduct your own contributions to the retirement account, similar to how a US 401k works. As long as the retirement account is recognized by the UK as a retirement account. So again, you do not have to report the employer contributions. You don't have to report your own contributions. And then the growth in the retirement account is similar to the United States in that it's tax deferred. So you would only report any of that income when you actually take distributions from the retirement account. But that's a great question. So we have a question from Ashwin. Does TFX also help with expats? You're a New Zealand citizen living in the United States and working for a New Zealand company. Yeah, so we work with a lot of individuals who are not U.S. citizens, but perhaps you're a visa holder or a green card holder, or perhaps you just meet the substantial presence test and you live and work in the United States. So we also would file your tax return, whether that's a U.S. resident tax return or a non-resident tax return. But we do have many clients we work with in a similar situation. So Lee actually followed up the question regarding the UK employer contributions. She also asked, her employer provides health insurance as a benefit. Where should I report this on the foreign earned income exclusion? So for this healthcare insurance, we would have to look a little bit more at how that is structured with your employer and determine whether it is considered taxable income or not. But if it is considered taxable income that we would report as part of your wages, it would be eligible, may be eligible for that foreign earned income exclusion. So as part of analyzing your situation, we do look at all the allowances and benefits provided by an employer to determine whether they are taxable or not taxable. And any of those types of allowances that are taxable, they're included as compensation and eligible for the foreign earned income exclusion. You have a question from Claudia. So she lives full-time in Mexico. She's self-employed part-time, but she only earns income from into her U.S. bank account in U.S. dollars. So because she lives and works full-time in Mexico, her income is considered foreign sourced. So she's performing the work in Mexico. Even though she is paid into a U.S. bank account and only earns U.S. dollars, that is still considered foreign source, and it's eligible for the foreign earned income exclusion and the foreign tax credit. And as self-employed, you want to always make sure you're keeping track of any deductions or expenses incurred as part of your self-employed business, so that we can report that to reduce your taxable self-employment, or in some cases, if you you do have to pay the self-employment tax. It can reduce the self-employment tax as well. Okay. We have a question from Courtney. She says, I have RSUs locked up with the company that I work for. I can't cash them out of this as these stocks haven't been liquidated yet. Do I need to report these RSUs on the FATCA, or do I wait until the RSUs liquidate? So the RSUs, if they are not vested, then you do not have to report them on the FATCA. At the point that they vest, then you would be taxed on the fair market value of those RSUs at the time of vesting. So your employer likely will provide you with statements that show that fair market value at the time they vest. And at that point, once you actually own the shares of stock, you would report those on the FATCA and then on the FBAR if they are held in an account. Kenza had a question. If I don't fill the FBAR or FATCA when I first arrived to the United States 5 years ago because I didn't know I have to, and I am owner of accounts in a foreign country, can I still reevaluate their base value now? Will streamlined procedure be a good fit for me? So I'm not 100% sure what you're referring to there as the base value. Perhaps you're looking at the thresholds that we talked about. So there are programs to go back. There's a delinquent FBAR procedure, which allows you to file delinquent FBARs. So you could go back and we could help you file for those 5 years. So that $10,000 threshold would apply based on whatever the balances in those accounts are each year. For the FATCA, if you lived in the United States, you'd be, depending on your filing status, whether you're single or married filing jointly, if you exceeded those FATCA thresholds in any of those 5 years, we can evaluate, what the best approach is if one of those amnesty programs or relief programs applies for you to report those. So you said, will the streamlined procedure be good for you? So if you've lived in the United States for the past 5 years, you wouldn't actually qualify for the streamlined foreign offshore procedure. You do have to be outside of the United States for at least 330 days in one of the 3 prior calendar years. But you could reach out to us. We could see if there's another type of program that applies for you to catch up on those delinquent filings. Tom had a question. He said, if I started work in Singapore since July last year, is the 330 days out of 365 days living outside the country prorated? Or am I not eligible because I wasn't outside of the United States for the whole year? So that's a great question. So how the foreign earned income exclusion works based on that physical presence test is that it looks at a 365-day period. So if your 365-day period starts mid-year, so in July in this example, you would look at, let's say it was July 1st. So you would look at July 1st, 2024 to June 30th, 2025 as your 365-day period. And so we would look at all of your travel dates outside of the United States and inside of the United States. And as long as you meet that 330 days outside of the United States in that kind of different 365-day period that's mid-year, July to June, then you still qualify for the foreign earned income exclusion. But your question about prorated, so the foreign earned income exclusion in that case actually would be prorated for the number of months in the calendar year that you met that requirement. So in this case, you would have met the requirement for 6 months out of the year, so you'd be eligible for half of the foreign earned income exclusion. And so in some cases, let's say that there was an individual that, moved outside of the United States and they wouldn't yet have that 365-day period to evaluate as of April 15th or June 15th. We can file an extension so that you can use one of those alternative 365-day periods that might end later in the year after the deadline. So, for example, if you moved outside of the United States in September and you needed to file the foreign earned income exclusion, we could wait until September of the next year so you can still have a 365-day period where you qualify. So the next question is from Laura. She says, do you prepare the paperwork to form a trust fund to protect real estate in Italy, or do you suggest to form an LLC instead to protect the assets? So we don't prepare any legal documents such as creating a trust fund or creating an LLC, but we could advise you of the tax implications of both scenarios, so that you could structure that the best way possible. But we don't actually prepare the paperwork to form those entities. We would prepare any tax returns that are required after the entities are formed. So Lord's asked, don't you have to wait 5 years before withdrawing from a Roth? So we did talk about this a little. It depends on how long your account has been open for. If you have like a brand new Roth account that you opened, or if you did a conversion, then you do have to wait the 5 years. But if you have a Roth account and you make a contribution this year, if that account has been open for at least 5 years and you don't make a conversion, you can take out that contribution.
Rebecca, I think we have time for 1 or 2 questions,
Sure.
and then we'll get onto our promo code.
Okay, sounds great. All right, let me look and see what questions. I have a rental income in the United States and consulting income outside of the United States. Can I claim and deduct the QBI deduction from the rental income and use the foreign earned income exclusion for the consulting income? It sounded like Rebecca said this is a combination that is not possible. So there, basically your income is sourced for rental property in the United States. As long as you meet the requirements for the qualified business income deduction on that rental property, you can claim it. There are certain requirements for the number of hours that you have to spend, working on the rental property, keeping separate business records. So as long as you meet those other requirements, you can still claim the QBI deduction on the rental income if that property is in the United States. But for your consulting income outside of the United States, you can claim the foreign earned income exclusion, but not the QBI deduction. So the QBI deduction is available for U.S. Business activity. So for the rental income, yes. For consulting outside of the United States, no. But you can use the foreign earned income exclusion. So Tom asked, if I sign up with TFX, will I get any person-to-person interaction? So that's a great question as well. So once you sign up with TFX, you will get assigned to a CPA. So all of our individuals that work with clients are either a CPA or an enrolled agent. We don't have any junior staff. Actually, on average, the average age of our CPAs and enrolled agents is 42 to 46 years old. So everyone has, like, on average about 20 years of working experience. So you would get assigned to a particular CPA. So the interactions are primarily by email, but you'd be dedicated to work with one particular individual. So you can send, questions, correspondence by email. We do find that is a keep track, both for us and for you, of the answers that you're given. You can have a written documentation that answers the questions that you have. And then if you do want to call, we do have separate services where you could set up a call to review your tax return, or if you have, tax planning that you want to do, we offer tax planning services where you would work either with the same CPA that did your tax return, or you would work with someone that does different type of tax planning suitable to your situation.
Thanks so much, Rebecca. Okay, so for those of you who have not had your questions answered live, please don't be concerned. We will be sending you an email with a response to those questions that have come through. So your question will be answered, perhaps not right away by either Reid or David if they don't get through it before the end of the webinar, or not by Rebecca. But before you go and before we wrap up, we do have some exciting news for everyone who's attended the webinar today. We are going to be giving you a $50 credit. So for those of you who are new to TFX, this is a special promo code just for you. During your sign up process, you can enter this code to process and claim your discount. So that's webinar 03-25. Please take that down. You can enter that as you sign up. If you already have an account with us, please don't worry about it. That's okay. You don't need to create a new one. All the details will be sent through to you via the email along with the webinar recording in a few days. So please be sure to check your inbox. We'll be answering your questions. We'll be sending you all this information. Thank you so much. Again, Rebecca, thank you very much for your expert help today, for the information that you shared with us. Reid and David, thank you so much for answering those questions so quickly and with such great expertise. I'm sure everybody who has had their questions answered already live on the webinar is really grateful. Thank you everyone for joining us today. It's been an absolute pleasure having you, and we can't wait to help you with your tax filing. Thank you.